Hello everyone, I'm Sari Gaikwad, Assistant Professor of Ramji Asant Channel Press, Rachmichan Purwala College of Commerce and Economics at Kharagpur. I would like to cover the topic of amalgamations of company as per the accounting standard 30. What is amalgamation? Amalgamation is a combination of two or more companies into an entirely new entity. It means two or more companies come together and doing the same like business. The term amalgamation has generally fallen out of the popular use in the United States, being replaced with the term like the merger and consolidations, but still commonly used in certain countries, such as India. And the amalgamation recent example are Maruti Motor operating in India and Suzuki based in Japan. And after the amalgamation, it formed a new company. It's called as Maruti Suzuki Limited. And second example is Mean Network Service Provider. P stand for Vodafone and I stand for Idea Network Service Provider. After the amalgamation is called as NC. The most important key point for amalgamation. Amalgamation company two or more companies into a new entity by merging their assets and line. This differ from the acquisition or takeover in that non-ousting companies involved in survive as company. Amalgamation can help to increase the tax resources, reduce the competitor, and save the company on taxes among their potential benefits. But it can also leave a monopoly if too much competition is eliminated and raise their weak entities that low or dangerous level and the cost some employ their job. How the amalgamation works? Amalgamation is typically happen between a two or more companies that are engaged in the same line of business or that share some similarity in their operations. Usually, the process involves a large entity is called as a transferring company. Absorption one or more smaller transfer company before the creation of the new company. The term amalgamation are finalized by the board of directors of each company in the plan is prepared and submitted to the regulatory for approval. The, in India, for example, that authority resides in High Court and Secretary at Exchange Board of India is said. The Indian taxation law defines the amalgamation somewhat broadly as the merger of one or more company with another company or the merge of two or more companies to form a new company. It refers to the merging companies as the amalgamating companies or companies, while a company then merged with or which is newly formed as a result of merger is an amalgamation. Now, the pro and cons of amalgamation. Amalgamation is a way to acquire a cash resources, reach the broader consumer base, eliminating a competitor, and save on taxation, and improve our economics of scale. Amalgamation can also increase the shareholder value and reduce the risk to the diversification and improve the managerial effectiveness. On the other hand, if too much competition is eliminated, amalgamation may lead to a monopoly, which can be a trouble for the consumer and the marketplace, as well as bring about the government intervention. It can increase the debt, possibly to dangerous level, by combining two or more companies together. The new entity assumes the liability of their part. The main advantages are can improve a competitiveness, may reduce the taxes, increase the economics of scale, has potential to increase the shareholder value and diversify the business. And the disadvantages are can concentrate too much power into a monopolistic competition, may lead to a job losses and to increase the new company debt load. Amalgamation versus acquisition. As I mentioned, in a typically amalgamation, two or more companies agree to combine their assets and liability and form a new entity. In acquisition, by contrast, one company purchases another company and take on the assets and liabilities. With a no new company being created as a result. So while amalgamation tends to involve a voluntary agreement between the different parties, and acquisition can occur without the consent of the acquisition company in what known as an hostile technique. What is an objective of the amalgamation? In general, the objective of amalgamation is to establish a unique entity capable of more effectively competing in the marketplace, while also benefiting from the general economic aspect. In that respect, it is not all that difference from the acquisitions and the similar strategy to add into corporate growth. What are the methods of accounting for amalgamation? There are two primary ways to account for an amalgamation in some of the countries. The pooling of interest method, which is used of value, and the second one is a purchase method, which is used a fair market value. As per the accounting standard 14, deal with the amalgamations of company. Why needed for the amalgamation? There are four major reasons to need for the amalgamation. First one, required a large scale of production, avoid the competition, increase in efficiency, and expansions of business. And the types of amalgamation, there are three types of amalgamation. First one is the amalgamation, second one is an absorption, and third one is an external reconstruction. Amalgamation means when two or more companies come together and doing a particular business under the name and fame of a new company is called as an amalgamation. For example, A Limited and B Limited come together and doing a particular business with the new name and fame of the company is called as an amalgamation. Then A and B company is an old company, is known as vendor company, is also known as a transferor company. And AB company, that means AB Limited, is a purchasing company, new company, and transferring. Second one is absorption. Absorption means what? When one existing company, it means a big company, take over the business of another existing company, it means a small company, is called an absorption. For example, A big company take over the business of B Limited small company. The A big company is an purchasing company and B Limited small company is an vendor company. Third one is an external reconstruction. When newly formed company take over the business of another existing company, it means a loss-making company or C company is called as an external reconstruction. Example, A Limited newly formed company is known as a purchasing company, take over the B Limited loss-making company is known as a vendor. Now, transfer company means what? The transfer company means the company which is amalgamated into the another company. It is also known as a vendor company. Now, what is a transferring company? Transferring company means the company into which is transferred company is an amalgamated. It is known as a purchasing company. A third point is most important: purchase consideration. What is purchase consideration? Purchase consideration means something in return. The amount is payable by a purchasing company to the vendor company for purchasing a business. There are three methods of purchase consideration is as follows. First one, lump sum method. Second one, net payment method. Third one, net asset method. Now, we will discuss first one, the lump sum. Lump sum method, it means there is no need to calculate a PC, that means purchase consideration. For example, Ramesh Limited take over the business of Suresh Limited a sum of rupees 3 lakh. Hence, the purchase consideration is rupees 3 lakh. And the second is net payment method. In net payment method, the amount is payable to the shareholder of vendor. For example, the shareholder of vendor company in two cases. First, equity shareholder demanded equity for equity. Second, cash for equity. Third, preference for equity. Case 2. Preference shareholder of vendor company demanded preference for preference shares. Second, cash for preference shares, and third, equity for preference shares. Similarly, the net asset method, it means asset minus liability. Asset take over at the agreed value less external liability at agreed value. We create a net asset method. Asset like fixed asset and current asset, and liabilities like external liabilities, borrowed part, and current liabilities. And the accounting procedure for the vendor company, and open the following ledger account, the following step. First one, a realization account. Second one, shareholder account. Third one, cash bank account. Fourth one, purchase company account. Sixth one, PC related account. It means purchase considerations related account. Realization account recorded all the sales of asset and repayment of shareholder account record all the equity and preference shares. Cash bank account it's not taken by the purchasing company. Okay. Accounting treatment for the ledger account. First one, you have to balance sheet transfer. Second, PCD. Third, PCD charge of setter. Fourth, close the ledger account. And accounting procedure for the purchasing company. Pass the necessary ledger entries in the forex. First, asset and liability taken over at the agreed value. Second, PCD FTC settle already charged. Third, debenture discharge or settle. Fourth, create statutory reserve. Fifth, set up or adjust a mutual dues. Sixth, set up or adjust of capital reserve for goodwill. What is a statutory reserve? It is a reserve which is created and maintained as per the law, and this reserve can create and maintain up to 8 years after the creation. If any company not create such types of reserves, then the company does not get a tax benefit from the government. The foreign statutory reserve are: first, export profit reserve; second, project export reserve; third, tea development reserve; fourth, development income rebate reserve; fifth, investment allowance reserve. These are the 5 reserve is most important. You can also refer the books like Manan Prakashans or Shet Publication. Thank you.